Right now, approximately 43% of every dollar held in American bank accounts has zero government insurance backing it. Not reduced coverage, not partial protection, none at all. And the fund responsible for covering the remaining portion contains just enough capital to back roughly 1.5 cents of every dollar it is pledged to protect. Those figures don't come from speculation. They come directly from official regulatory filings. Once you truly grasp what that means in real-world terms, the question stops being whether you should panic. The question becomes why your bank has that little blue sticker near the entrance, and whether it actually means what you assume it does. Here is what most people get wrong about bank failures. The average person pictures something straight out of a film. Crowds storming the building, absolute chaos, people pounding on locked glass doors, and then silence. Your money simply vanished. That is not how it actually unfolds. The real process is far more procedural, far more nuanced, and depending on how your funds are organized, either completely fine or genuinely devastating. The difference between those two outcomes often comes down to a single conversation that takes less than 5 minutes. I want to take you through the exact mechanics. Not in the vague, comforting way financial television tends to do it, but in the precise step-by-step way that tells you which of your dollars are genuinely protected and which ones are essentially gambling every time a regional bank quietly falls short of its capital requirements. Stay with me, because something I'll show you later in this video flips the conventional wisdom about bank safety completely on its head. The thing you probably believe is shielding you might actually be the very reason you wind up exposed. But first, let me introduce the central analogy because we'll return to it throughout this entire discussion, and it's the most straightforward way I've ever found to explain deposit insurance. Picture deposit insurance as an umbrella, a very well-made umbrella, durable, no leaks anywhere. But it only reaches so high. The umbrella protects everything beneath it perfectly up to $250,000. Every dollar below that line stays completely dry. Everything above it gets soaked through. The rain doesn't negotiate based on how close your money is to the edge. $1 over the line and that dollar is drenched. Now here's where the analogy becomes more unsettling. The company that manufactures the umbrella, the deposit insurance fund itself, currently holds approximately $153.9 billion in reserves. That sounds enormous. It is a substantial sum. But the total amount of deposits sitting inside American commercial banks right now exceeds $18 trillion. That means the umbrella manufacturer has enough material to cover roughly 1.4% of everything it has promised to protect. Regulators call this the reserve ratio. The long-term target is 2%, and the legal floor is 1.35%. The fund barely climbed back above that threshold in mid-2025. During the savings and loan catastrophe of the 1980s and 1990s, and again during the 2008 financial collapse, the fund was completely wiped out. Not strained, not stretched, completely gone. Insured depositors were still covered, but only because the fund borrowed from the federal government. The umbrella company called in its line of credit. None of that means you should sprint to your bank tomorrow and withdraw everything. It means you need to understand precisely what that umbrella actually covers and where its edges are. Let's start with the mechanics, because this is where the first major misconception takes root. Most people assume that when a bank collapses, there's a turbulent transition period during which they can't touch their money for weeks, maybe months. That is not typically what occurs. When a bank or savings institution fails, the relevant agency responds immediately. If another institution agrees to acquire the failed bank's deposits, customers automatically become account holders at the new institution. From the customer's perspective, the transition is usually seamless. Regulators almost always move on a Friday afternoon. They deliberately wait until the close of business, shut the bank down, and have insured deposits transferred to a new institution before the branch opens again Monday morning. Most depositors recover access within 1 to 2 business days, so the fear that you'll wake up and your account will simply be empty. That fear is misdirected when it comes to insured deposits. The money below the umbrella line is backed by the full faith and credit of the federal government, which is about as solid a guarantee as any promise gets. Since deposit insurance was established on January 1st, 1934, not a single depositor has lost insured funds. Over 90 years, zero losses on insured deposits. But here's the reversal that almost everyone misses entirely. You think the danger is losing your money when a bank fails. That's not actually the core problem for most people. The real problem is not knowing which of your dollars are already sitting above the umbrella line in the first place. Here's the data to back that up. As of March 31st, 2025, approximately 39% of all bank deposits were uninsured. Nearly 4 out of every $10 held in American bank accounts is currently sitting above that coverage line. And a significant portion of those dollars belong to people who genuinely believe they are fully protected. I want you to sit with that for a moment. Not corporations, not hedge funds. Ordinary individuals who accumulated savings over 2 decades, opened a second account to manage cash flow, established a trust for their children, launched a business account for a side project, and ended up structuring everything in a way that technically placed money above the limit, without ever realizing it. In a few minutes, I'm going to walk you through the ownership category framework. Honestly, it's the most practically useful information in this entire video. But before that, I need to tell you about a startup founder. I'll call him David, because his experience from March 2023 is the clearest illustration I've ever encountered of what actually happens when things fall apart. David ran a software company with roughly 30 employees. The bank he used was well known for serving technology and life sciences companies, and its deposit base was heavily concentrated among customers whose balances far exceeded the $250,000 insurance ceiling. David had $2.3 million deposited there, money reserved for 6 months of payroll. He didn't consider it a risky financial move. He thought of it as a checking account. According to the bank's final call report filed on December 31st, 2022, the institution held $175.5 billion in total deposits, of which an estimated $151.6 billion, roughly 86.4%, was uninsured. On the morning of March 10th, 2023, David woke up to news that the bank had been seized by state regulators. He had $2.3 million inside it. $250,000 was insured. The remaining $2,050,000, the funds allocated for March payroll, April payroll, health insurance premiums, and office rent, was above the umbrella line. Many startups in the technology sector had millions or even hundreds of millions deposited at that institution, money they depended on to operate and compensate their teams. David spent 36 hours not knowing whether he'd have to inform 30 people that their paychecks weren't coming. 2 days after the failure, regulators invoked exceptional authority and jointly announced that all depositors would have complete access to their funds. The following morning, David recovered everything. But here's what the news coverage glossed over. He got it back because the institution was deemed significant enough to trigger what's known as the systemic risk exception, an extraordinary measure that allowed regulators to protect even uninsured depositors using the proceeds from selling the bank's assets, without technically drawing on taxpayer funds. As one official statement noted, businesses shouldn't depend on the possibility of special accommodation to protect them from bank failures going forward. That's the wager David didn't realize he was placing. Not, will my bank fail, but if my bank fails, will it matter enough for the government to use extraordinary powers to rescue me? Now, that bank was not an isolated case in terms of its uninsured deposit concentration. Uninsured deposits made up nearly 3/4 of deposits at 2 other institutions that failed around the same time, and 94% at David's bank. All 3 had large concentrations of funds among a relatively small number of depositors. 3 of the 4 largest bank failures in American history occurred in the same calendar year. All 3 held an abnormally high share of uninsured deposits. And here's the crucial contrast. When a different bank failed in July 2008, before any systemic risk exception was invoked, before any extraordinary measures were taken, uninsured depositors received 50 cents on the dollar for any funds above the coverage limit. They lost half of anything determined to be uninsured. One depositor, a police officer and single mother, I had $360,000 at that institution. She had opened the account just 2 weeks before it collapsed. That $360,000 represented the proceeds from selling her home, money she needed to make a down payment on another property. She later said she had explained to the branch manager exactly why she needed those funds kept safe. The manager nonetheless advised her to place the entire $360,000 into a single account. She recovered $250,000 in insured funds, then 50% of the $110,000 that exceeded the limit. She walked away $130,000 short. And here's the lesson from her story that the branch manager should have shared during that conversation. You don't need multiple banks to protect more than $250,000 at a single institution. You just need to understand how ownership categories function. This is the most valuable thing I'll share in this entire video. Listen closely. Deposit insurance covers funds according to the ownership category under which accounts are titled. A single account in your name alone carries a $250,000 limit. A joint account shared with a spouse has a separate $250,000 limit per co-owner. That's $500,000 of joint account coverage. An individual retirement account at the same bank receives another $250,000. A business account adds a fourth separate $250,000. And a revocable trust account. This is the one most people never use. Provides $250,000 per eligible beneficiary named on the account. All trust deposits owned by one individual are insured for up to $250,000 per eligible beneficiary, up to a maximum of $1,250,000 if 5 or more eligible beneficiaries are named. So if you hold a revocable trust account listing 5 beneficiaries, your spouse, 3 children, a sibling, whoever, that single account receives $1.25 million in coverage at the same bank. You don't need to scatter money across 7 accounts at 7 different institutions. You need to structure the accounts you already have. Most people can protect $500,000 to well over $1 million at a single bank simply by using multiple ownership categories strategically. Let me make this concrete. Consider a hypothetical person. I'll call him Mark. Mark is 44 years old and has accumulated $450,000 in savings. Everything sits in 2 accounts at the same bank. A savings account holding $300,000 and a checking account with $150,000. Both are titled in his name alone. Under the rules, those 2 accounts are combined under the single ownership category. His total coverage is $250,000. He has $200,000 above the umbrella line and has no idea. Now, Mark restructures. He opens a joint account with his wife and transfers $200,000 into it. He opens an individual retirement account and moves $50,000 of eligible funds. He establishes a payable on death savings account, naming his 3 children as beneficiaries. In roughly 40 minutes, Mark went from having $200,000 completely uninsured to having every dollar fully covered. At the same bank, without switching institutions, without losing access to any of his funds. The umbrella didn't change. Mark just learned to stand beneath all of it. Now, before I get to the part that genuinely surprised me during my research, the part that involves where your money might actually be structurally more secure than you'd expect, let me be honest about a gap in how people typically think about this. Understanding the ownership category rules is one thing. Having a system that keeps you protected as your net worth grows past certain thresholds over time is something else entirely. I built a resource called The Exit Code, a research-based framework drawing on 50 years of retirement data. I built it precisely because of situations like this one. The numbers are one thing. Structuring everything so those numbers actually work across your real accounts, your actual tax situation, and your specific withdrawal timeline. That's a different challenge altogether. 2 sections are especially relevant to this conversation. The first covers a dynamic withdrawal method that shows how a sequence of returns event, including a capital lockup resulting from a bank stress scenario, can permanently damage a retirement plan that looked perfectly sound on paper. The second covers what I call the 58% rule, which demonstrates that being forced out of your accumulation plan earlier than expected whether because of employer restructuring or an unexpected financial disruption, is statistically more likely than most people's plans account for. It's 8 chapters, no filler, built entirely on the kind of data that takes a long time to locate and even longer to synthesize into something actionable. You can find it through the link in the description for less than the cost of dinner for two. And the longer you delay getting the math right on this, the more compound interest is working against you rather than for you. Now, here's the thing that genuinely caught me off guard. You probably think the most dangerous place to keep large amounts of money is a massive bank. Too big to fail, politically connected, with complex instruments and exposure to everything problematic in global finance. You'd be mistaken. This is one of the stranger inversions in the entire deposit insurance system. When one of the largest banks in the country failed in 2008 and was acquired by another institution, uninsured depositors, who represented 24% of total deposits, recovered 100% of their money. Not because they were insured, because a buyer was found quickly enough. When a different, smaller bank failed that same year, uninsured depositors recovered only 50 cents on the dollar. That smaller failure was actually the most expensive in deposit insurance history, a $12.4 billion hit to the fund. The larger bank had $307 billion in assets. The smaller one had $32 billion. Smaller, less prominent, harder to place. Uninsured depositors lost half. The inversion works like this. When a large bank fails, a buyer is almost always found. The assets are attractive, the customer relationships are valuable, and the acquiring institution typically assumes all deposits, including uninsured ones, as part of the transaction. When a small bank in rural Oklahoma fails, no buyer may materialize. That means uninsured depositors enter receivership proceedings and wait years, not weeks, years for partial recovery. If uninsured funds exist, depositors may eventually receive periodic payments on a proportional, cents-on-the-dollar basis as assets are gradually liquidated. Sometimes that process takes several years to complete. My money is at a community bank, so it's safer. That sentence has a very specific failure mode that the person saying it doesn't understand. There's a second layer to this, the systemic risk exception. The mechanism that protected David's payroll only gets triggered when regulators determine that a failure poses genuine risk to the broader financial system. Panic events at mid-sized institutions can cascade into potential financial crises, so regulators intervene. The irony is that your money held at a large, systemically significant institution benefits from an implicit safety net that your money at a small community bank simply does not. The government will not allow the largest institution's uninsured depositors to absorb losses because the resulting panic would be too destabilizing. But if a small local bank loses its capital to bad loans and cannot attract a buyer, you might receive 50 cents or 40. In at least one recent case involving a small bank failure in late 2024, regulators indicated they would initially make 50% of uninsured funds available to depositors, with that percentage potentially rising as remaining assets were sold. This isn't a conspiracy. It is the logical outcome of how the system was designed. Deposit insurance was created in 1934 following the banking catastrophes of the Great Depression. In the panic following 1929 and during the first 10 months of 1930, hundreds of banks failed. Altogether, roughly 9,000 institutions collapsed during the 1930s. By April 1933, approximately $7 billion in deposits had been frozen in failed or unlicensed banks following the bank holiday declared in March. The objective was never to build a perfect system. The objective was to stop mass panic from dismantling the entire economy. Stabilizing legislation reduced bank failures from over 4,000 in 1933 to 61 in 1934. The umbrella was built to prevent the worst possible outcome. It was never designed to protect every dollar under every circumstance. Deposit insurance will protect your money. That statement is 95% accurate, and 5% dependent on a set of factors your bank's marketing team will never walk you through. Now we need to talk about where money can genuinely be more secure. This is the section most financial advice skips entirely. There are two things in the American financial system that have a structurally different relationship with institutional failure risk. The first is a brokerage account at a member firm of the Investor Protection Organization, created specifically for that purpose. The second is a treasury bill purchased directly through the government's online portal. On the brokerage side, a federally mandated private nonprofit organization exists specifically to protect securities and cash in brokerage accounts against the risk of a brokerage becoming insolvent. This protection covers specific types of securities: stocks, bonds, government securities, money market mutual funds, and certificates of deposit. The coverage limit is $500,000, which includes a $250,000 sublimit for cash. But the more meaningful protection is structural and worth understanding carefully. Securities regulations require brokerage firms to keep customer assets completely separate from the firm's own assets. At major brokerages, for example, client securities are segregated from the firm's holdings and maintained at third-party depository institutions. Your index fund shares at a brokerage are not the brokerage's property. They are yours. They are titled in your name, held in segregated custody. If the brokerage fails, the underlying securities don't evaporate. They exist independently of the firm's financial condition. According to the Investor Protection Organization, in over 99% of the brokerage failure cases it has handled, across more than 50 years of operation, eligible investors recovered their investments in full. Here's the striking implication: that index fund holding $200,000 in broad market exposure may actually be structurally better protected from institutional failure than a savings account with $200,000 sitting above the deposit insurance limit at a bank. Not from market risk. Obviously, the index fund can decline 40% in a downturn, but from the specific risk of the institution itself collapsing and taking your principal along with it. A bank deposits your money into assets on its own balance sheet. A brokerage holds your securities in segregated custody. One arrangement places your money directly on the institution's books. The other keeps it as yours regardless of what happens to the institution's finances.